Welcome back, guys. So this video, we are going to break down the final update that is going to change everything in how we understand the trend and the variations of pullbacks that is provided when a trend is evolving, so that we can always locate the correct higher low when we are in an uptrend or the correct lower high when we are in a downtrend. We are going to use a simple tool, the Fibonacci tool, back to the basics. And we need to understand a very basic logic first, which is the Fibonacci tool is designed to help us identify the midpoint or the 50% as a guide in where the price should return before we can consider the possibility that the market is going to continue going in one direction. So for example, if the market is bullish, right, we always need to wait for the market to return at least to 50%, okay, to start to think about an opportunity to trade in the direction, so that we can position ourselves in this location here, which is going to be this location here is going to be our potential higher low. And then after this higher low is created and we have other confluences of confirmation, such as variations of AMD, accumulation, manipulation, distribution, or break of structure, fractal break of structure, then we can take the buy trade in that direction. Now, sometimes what happens is that the market will fail to return to the 50%. So for example, the market sometimes will start to expand in one direction. It will return to 50%, and then it will expand. It will again return to 50% and expand or return into 50%. And here is where sometimes it gets interesting, is that sometimes you will notice that it will not return to 50%. It will continue to expand higher. And this is where we have to continue to keep our last level, which is this level, for example, as our new 100 level. So whenever we are looking for a higher low in an uptrend as an area of potential positioning so that we can trade in the direction of the trend, we always want to update our Fibonacci levels. So when we are looking to understand where is going to be the potential retracement, the 50% level, the 61.8 and the 78% of the Fibonacci, we always need to start on the lowest low and expand to the high. Okay? Why? Because now, at this point, when the market starts to show sign that is coming back down, then this is where we're going to place our zero level. Zero level has to be at the extremity of the candle high, and then we wait for the market to provide a higher low in these three key levels. Okay? Now, we need to wait for 50%. Now, minimum, right? The maximum is going to be here, and obviously the ultimate maximum is here, right? Here, which is the opposite direction. But again, when that happens, then the market is going to pass beyond the 0%. Once it passes beyond the 0%, that last rejection, so if the rejection was 50%, or the rejection maybe was 61% or 78%, that last rejection is going to become your new 100 level for your Fibonacci. Okay? So it's going to become your new 100 level, and then you're going to adjust your zero level to the next highest point before the returning towards the 50%, so that you can always get these three key levels in line with the real pullback and the real trend and the real higher low, vice versa in the opposite direction. So remember, I was explaining that at some point they fail to come back at 50%. That is where you're going to use the Fibonacci dynamically by updating all the time. Like you see, I just placed the 100 level at the last rejection point. I'm going to adjust it here, again 50%, and I'm going to continue doing this every time, right? So now, you see here, for example, I can expand, and you can see the market did not come to 150%. So that, and it continues to go higher, higher. We do not move the 100 level. We only have to continue to expand, expand, expand until the market decides to return finally, okay, to that 50% level or more, to provide an opportunity for us to take our trade. So as you can see, so for example here, the market fails to return to 50%, so we continue to expand. The market again fails to come to 50%, we continue to expand. The market goes higher, we continue to expand, and here we have our 50%. In general, when the market does that, there is a potential change of trend. So we might get a short-term buy opportunity, but then the market will a lot of the time fail to go above the 100 level and start to build liquidity and patterns that basically gives us a clear understanding that they are about to manipulate and then distribute in the opposite direction and start the whole process again in the opposite direction. Okay, so I'm going to show you a few examples. I'm going to show you a few examples on the chart, and then you will see that this pattern is repetitive, and this is the last update that we need to be completely fluent with the market at all time, with the real order flow of the market, so that we are in line with the real trend. So right now we are on the daily time frame. All I have to do to show you this back test, I can take the lowest point, which is right here. Okay, I'm going to zoom in here. Okay, just so you can see the back test example. I want to start from the low, right? And then obviously I'm going to expand to the high. We can see here that automatically the market comes near the 100 level, but it doesn't go lower. So that level is still valid because it didn't go through. That level is still valid, right? So now the market goes higher. Okay, so when it goes higher than the 0 level and it starts to return, this is when I'm going to now continue to adjust my 100 level to the last low, which is here, and adjust my 0 level to the turning point. And we can see the market rejects 61.8 and goes above the 0 level. At that point, I can also readjust my 100 level to this new low to get the next 50% or the next higher low. And every time the market is attempting to return, I just adjust my 0 level. And then we continue that process until the market retests our 50%. So we can see here, for example, if I place my 0 level above this high, the market fails to come to 50. I continue to adjust again to this high. It fails to come to 50. And then I continue to adjust until this high. As you can see, it fails to come to 50. And I just continue that process over and over until the market decides to come to 50%. And as you can see, when we adjust to this level, this is when the market decides to go deep and it goes to 78%. But observe, let's extend this a little bit more. Observe what I mentioned earlier on. They will, when they return here or here, they will pretend to go higher, but they are about to possibly change the trend. It's a possibility or continuation. So that's a deep retracement, allowing us to take another buy trade here, which is the actual higher low based on the order flow of the daily time frame, which is the best key level that we need. And then we can continue to trade in that direction. If this is our last level, then our 100 level now becomes adjusted to this last rejection level. And then we start the process all over again. Because it's going to allow us to get to that point where we can get a retracement. So for example, here we have this, when we start to draw from here, then we're going to start with the first retracement here. As you can see here, the market fails to come to 50 level, and then we go higher, which is this one. The market fails to come to the 50 level. So now we go again higher. The market again fails to come to the 50 level. It retests the 0 level, comes to the 50 level. So that's going to be our new 100 level, and that's our positioning for this key level. Then we're going to adjust the 100% here. So you see the process is repetitive, is very easy. Again, we can see it fails to come to 50. So we dynamically move the zero level higher until the market comes deep enough to provide an opportunity. So here, for example, it comes to the 50 and lower within our 3 key levels. It provides a short-term opportunity. It comes back again. It builds liquidity, comes back. It grabs the liquidity by going to the 78%, and then it shifts back to the 100%. So now if that is our last level, we have to continue to adjust, always helping us to stay in line with the real trend at all times, right? So now, same process. As you can see, the market comes to the 50, 61.8, and then it fails to go higher, and then it changes direction. The good thing is we can do this in both directions, right? So because the market goes down this way, so it's the same process even when you are counter trading. Counter trading, because the trend is relative, right? Because I can say that's an uptrend, but that's also a downtrend, right? So all these micro areas, it's the same process. You do the same process over and over, over and over. So the opposite logic is very simple. I want to use a difficult area so that you can see. So for example, that can be an opposite logic. Remember, we are on a daily time frame, so that this is a lot of pips, right? So here we start here. We have the first retracement. The market fails to come to 50. Fine. We extend the zero level here. And again, because I'm looking for a lower high in a sell momentum, my 100 level always have to start at the top. My zero level at the bottom. Vice versa, if I'm looking for a buy trade, my 100 level start at the bottom, my zero level is at the top. Okay, that's very important. Now again, we see 61.8, the market drops below 100. So now this becomes this area right here, right? And then we adjust it here. We get another sell opportunity here. You see, they fail to go. We still get a good sell opportunity. They fail to go below. Now we can connect this as a potential higher low with this trend in this area, right? So if we take this trend in this area, we start by looking at this low. Okay, so from this low, okay, to this first retracement here, the market fails to come to 50, so we extend right here. The market comes to 50 in our zone, minimum 50, and then it goes higher. So that becomes our new 100 level right here, and then we expand one more time. And this works on every time frame, okay? So I'm just showing you the daily time frame because it's the best time frame for either short-term trades or long-term trade, right? So here again, we have adjusted, and then the process repeats. You see, it's as soon as it goes above the zero level, then this becomes our new level, right? But then you see, it becomes our new level for long term, right? So that means for long term. But short term, which is here, you have this level as well, which allows you to enter your trade here, and it becomes an upside down head and shoulder, and you can trade the continuation here. Okay, so for example, when the price was here previously, when the Fibonacci was at that level, and then your 100 level was here, and then the market starts to dip below here and start to go up. Maybe you missed an opportunity to enter here, but then that's an expansion from here to here. The market starts to return, so you can actually adjust from here to here so that you can get entry at the 50% and then take the breakout towards the breakout above the high, right? So again, this is like a fractal perspective. So here, that's the last rejection, and then same process over and over again. And then you can just see that it will continue to try to retest the 50. You continue to expand. It will try to retest the 50. You continue to expand. And look, here, it tells us to buy in this location and in the opposite direction here. Let's change the color of the fib. We had a sell. We had a sell opportunity here from drawing the fib from here to here. Where is the 100 level? So we had a first sell opportunity from this high to this low, from here to here. Okay, so let's put this on the side. As you can see, we have the sell from this direction, from this 100 level to this zero level. We have a sell here. Okay, the market goes below, right? Now I adjust automatically my 100 level here, and then I adjust my my 0% to the returning point. The market provides a short-term opportunity. But then again, as we saw earlier on, the market came to that level, which is telling us in the opposite direction when we have our key level starting at this low, right? And then we see our 50% is right here to buy. So we know, okay, the market is going to fail to go lower to the 100 level in the opposite direction. So it's ultimately just a pullback in the bigger trend. And then we are able to take the buy trade here. And then the process starts all over again. And it always allows us to stay in line with the market trend, right? So if you take this buy trade in this area, then your next pullback is going to be, excuse me. So you take this buy trade in this area, your next pullback is going to be here. Okay, that's going to be around the 78% fib and lower. That's fine. You take your buy trade here, right? Again, you can readjust this like so. And then here, you can see the process is similar, right? So guys, that's all I wanted to share with you. Hopefully that makes sense. Okay. And like I said, this is the way to be consistently always in the order flow of the market, regardless of the time frame, because again, trends has variations up and down, and it's all about understanding how to identify the true higher low and the true lower highs whenever we are trading. Thanks for watching. Drop a like, comment, subscribe, and yeah, if you enjoy, drop a comment in the section below. Thanks for watching. Bye.